you doing to factor inflation and rent growth into your analysis? How are you measuring your rental increases? Are you doing rent surveys comparing your property to your competition? What about vacancy? You should be at 95% occupancy for optimal rent. Less than 95% and your rents are too high. More than 95% and your rents are too low. Now compare your rental increases to the inflation rate, which is currently 5% according to the Consumer Price Index as of May 2021. If you aren't raising your rents by the current rate of inflation, your returns are diminishing in real terms. In other words, if you initially forecast a 7% cash-on-cash return, but are only raising your rents by 3%, your cash-on-cash return is actually only 5% because of the net loss due to inflation. If you aren't able to raise your rents by the inflation rate, you need to reduce your expenses to make up the difference. Scrutinize each line item and squeeze your expenses as tightly as you can to make up for the loss due to inflation. With the current pricing of properties today, there's very little room for error when analyzing the financials. Even more important than the cash-on-cash return is the internal rate of return, which measures the return of your investment while it's in the investment using the time value of money. In other words, a dollar today is worth more than a dollar tomorrow, so you need to account for the effect that inflation has on your investment. Contact me for a financial analysis of your property to determine if you're prepared for the upcoming financial and tax issues that are on the near-term horizon.